Hey everyone, hope you're well and hope you're having a good start to the week. My name's Ben and thank you for joining me. Today being Tuesday, I feel it's a good time as always to go through some of the recent stories I've seen around some of the companies I hold, which I hope will be of some interest to you. And as always, we will finish off with a portfolio update to see what's changed over the last week. I will include all the descriptions for the stories down below, so go and check that out. And as always, if you think there's something I've missed, please drop it down in the comments and let's have a chat about it. So the first story I wanted to go over was an article that I found because it has a mention of ABBVIE in it. And the article itself is called "These Three Value Stocks Are Absurdly Cheap Right Now." And it highlights the reasons why they believe ABBVIE is currently undervalued. So for anyone that has watched my previous weekly updates before, you will know that I've kept updates around ABBVIE and the Allegan situation, and that is kind of highlighted here. The article also highlights that the deal originally that took place in may have helped the company boost net sales totaling 45 billion, which is around a 37% increase to the company's net sales. ABBVIE is currently trading at a PE of 37.84. However, looking at the forward forecast for the PE, it is forecasted for around 8.75. This shows that analysts believe that the actual revenue and the earnings of the company are going to increase over the next few years. If we look at that, the forecasted earnings are around 59 billion, whereas the current earnings and revenues of ABBVIE sit at a 45 billion revenue and a net profit of 4.6 billion, which is a reduction on last year's figures of 7.8 billion. Looking into their income statement to see if we can work out what's going on, this looks like it's mainly caused by an increase in the other income expenses and the net non-operating interest income expenses on their income statement. I feel that ABBVIE will do well over the next few years, especially since they've diversified their portfolio and their product portfolio through the acquire of Allegan and other product ranges. They did close on market price at $110 on Friday, and they pay a quarterly dividend of around $1.30. Moving over, we also have a story around AT&T, who recently had their Investors Day. Following this, it seems that they have raised their estimates for their number of subscribers coming up, and these estimates are now around 120 million to 150 million, with the service breaking even in around 2025. This is an increase from their previous estimates, which sat at around 100 million in October 2019, and they are also looking to add a version of HBOMAX, which is lower monthly fees, but does include adverts for viewers to watch. So we'll see how that goes. I actually quite like the idea. It should allow more people to access HBOMAX if they're not happy to pay the full price, but would be happy to watch a few adverts now and again. So I think it's good bearing in mind that HBOMAX are one of the more expensive streaming platforms, coming in at around $15. HBOMAX is also limited currently due to its locational issue. It's not worldwide. As far as I'm aware, it's currently in America and maybe a few other places. It's definitely not in a lot of Europe and in the UK, and they have said they're planning to roll that out quicker, which will help rack up the amount of subscribers that they could get access to. AT&T are currently trading at a share price of £29, and their forecasted earnings for the end of 2023 is around 174 billion. AT&T will need to start reducing their outgoings and their expenses to start turning more of a profit, as they had negative earnings in the last year. So they have mainly accrued that due to, according to their income statement, there was an increase of 16,000 in special income charges. Overall, I think AT&T will stay on top and start churning a profit out over the next few years, and then the share price will start to recover quite strongly. And that is just my opinion, but let me know what you think down in the description below. And finally, on the news, we have a quick story around Broadcom, and the article itself reads, "Why top tech stock Broadcom is still a buy after a Q4 report." The article itself highlights the potential opportunity from the recent drop in Broadcom's share price. It fell around 10% as a outcome of the tech center sell-off, and it hasn't fully returned back to its previous level. The article also highlights the recent global semiconductor shortage and says that it would bode well for Broadcom's trajectory for the rest of the year. Broadcom currently has a revenue of 24 billion, a net income of 3.9 billion, a free cash flow of 12.3 billion, and they have an estimated 5-year return of 71%, which is around 30%-ish higher than the Vanguard S&P 500 expected return. Their current share price is trading around $451, which is around a 92% increase over the last year, and they pay a quarterly dividend of $3.60. I am looking to pick up some more Broadcom because I do think they are a strong company. However, I currently only hold 0.1 of a share that I bought in at a purchase rate of £252, which is around $332. Now, that's a few of the stories that I've seen over the last couple of weeks. So I've added all the links down in the description below, along with a few additional ones that might be of interest to you. So feel free to check that out after you've smashed the like button. But let's move over to my Trading 212 portfolio and see what's changed over the last week. Jumping into my purchases, I had intended to pick up a few shares of PPL, as I mentioned in my last video. However, on Monday, something happened and I actually got a price trigger letting me know that a company I invest in has hit a low price. In this case, it was Games Workshop, which is a company that I really like, and I don't believe actually gets enough attention here on the interwebs. Anyway, I got a notification to let me know that Games Workshop dropped to around £94 per share. So on the Monday, I took the opportunity and grabbed a further 0.2 of the share for a share price of £93, costing me a total of £18.88p. Unfortunately, it was the only amount that I could afford at the time, and the price had started going back up before I had additional money, and it ended the week at a share price of £98 per share. Next, I also picked up a purchase of one share of Store Capital for £23.99. This was on the 12th of March, and Store Capital are a internally managed net lease real estate investment trust, and they're currently trading for around £24.25 per share. Store Capital also have a nice growth in revenue, a growth in net income, a growth in shareholder equity, and also a growth in dividend payments, with the company up a total of 132% in net income over the last 5 years. Though over the last year they have seen a drop of 30%, but I believe that's mainly due to COVID and the pandemic. So not massive issues there. They have seen an increase in 33% in dividend payments over the last 5 years as well, and they're currently paying out around 36 cents per share, with the next estimated ex-dividend date to be the 30th of March. Talking of dividends, let's move over to the payments that got made last week, and we can see that I had two payments on the 9th. One from Intel, which paid out 2p for holding 0.1 of a share, and the second one from Wells Fargo, who paid out 6 pence for holding 1 share. So not much activity on the dividend side of the portfolio, but this does bring my full dividend return from the portfolio up to £31.14p. I am hoping to see a few more coming over the next week and two. If you haven't seen it already, I have a monthly update where I've got my forecasted return for this month. So we're a little bit off that target so far, and I'm hoping to get all of those payments over the next couple of weeks. And if you're interested, I have linked that video down in the description below. Overall, in regards to gains, it's been quite a good week. My portfolio moved from 7.24% in return up to 9.94% return, which totals a weekly return gain of about £60, for a total of £221 overall. The portfolio is sitting at around £2,454, which when compared to the actual deposits of my own money I've made into the ISA, we can see that that figure is £2,151, meaning that if I sold all of my companies today, I would gain around £300 from this whole venture. Obviously, I'm not going to be doing that, but it might be interesting to go and look at the best and worst performing assets in the portfolio. In first place, we again have ABBVIE, who are currently ahead with a 97% return on gain. Then we have ING, who's coming in at 87.54%. And in third, just behind ING, we do have Barclays, who come in with an 87.15% return. And in regards to our two worst performers, we have Dominion Energy, who is down 14.12%, followed by Walmart, who is down 11.90%. However, in both cases, this loss is largely related to the exchange rate as opposed to the company, but both companies are down as well as the poor exchange rate on them. So not great, but if they're still doing well on their next financial releases, it may be a good time to pick up some more shares. And mostly that's it. I hope you've enjoyed the content on the companies and the bit of information that I've been able to provide. Do remember that even the like button does need some love, so feel free to go down and give it a nice little tap. If there's anything you want me to include in any of these videos, do let me know down in the comments. I had a comment asking for more information around why I'm buying companies and what I see in them, so I'm hoping by providing the financial data in this video that has helped. But until next time, as always, remember to invest, save and subscribe.